Okay. Now, the opposite of a charitable remainder trust is a charitable annuity trust. And if I put $1 million a year into a charitable trust, and instead of retaining the right to the fifth, and let's suppose it's my corporate bond that pays $5,000 or $1 million pays $50,000 a year, okay? Now, instead of retaining the right to the $50,000 a year and then the remainder goes to charity, what I do is in a charitable lead trust is I say the charity will get $50,000 a year for the next 20 years. And then at the end of 20 years, whatever is left goes to my children. Okay. And you get a charitable income tax deduction and a charitable gift tax deduction for the present value of the right to the charity has the right to receive $50,000 a year. So essentially, in that situation, okay, so basically what happens here is the key is that the money in the trust earns income. And the IRS assumes in today's environment that the income producing asset is only going to earn what's called the Section 7520 rate, which is currently 2%. So if I have a $1 million bond earning 5% or $50,000 a year, and I give $50,000 a year to charity as a charitable annuity, the IRS is assuming it's only earning 2% or $20,000. So if I'm giving $50,000, the IRS assumes the extra $30,000 is principal. And it over 20 years, that amount of principal that is artificially being depleted, even though it's earning really 50,000, has a present value of $1 million. So I get a charitable deduction of $1 million for $1 million going into the trust. So that means the value of the remainder interest going to my children at the end of 20 years is zero. And we call that a zeroed out clap. So the key here is, again, the more money in the trust, the more income it can earn. And if I start, but remember, the charitable deduction for the charitable lead trust is the present value of all future payments. So now normally people would say $50,000 a year to charity for the next 20 years. But the key is I can vary the payments for a charitable lead trust. And I can have the payments be low in the beginning so there's more principal earning income. And what happens is, in that situation, the extra income goes to my children, free of all gift and estate taxes. So here's an example. Senior has a asset worth $80,000 that's paying a corporate bond that's paying $41,702 a year to charity each year. Okay. So let's suppose that the individual puts that into a charitable lead trust, and the present value of $41,000 a year, because it's only assuming it's earning a lower amount, is depleting principal. So the charitable gift to my children of the remainder interest is zero. So let's look at how that works financially in the next slide. Okay. What happens here is it's earning, say, 5% or $40,000 a year. So what that means is every year that it earns 5% on the principal, every year the charity gets $41,000. And what happens is at the end of 20 years, there's $743,000 that is given to your children at the end of the term with no estate and gift taxes. But in this situation, you can see I'm depleting principal. So let's go on to the next slide and change the assumptions.
By the way, what was the ratio of this? What was the value of the charitable deduction? 100%, right?
100%.
Okay.
So basically, what's left for the children is zero.
Okay, so you put 800,000 into this box, and this box pays your favorite charity 41,000 a year. You get an $800,000 income tax deduction when you set it up, and then
Tax deduction.
What's that?
And a gift tax deduction.
A gift tax deduction. And even though at the end of year 20, in the greatest quarterback sneak of the tax world, $743,000 goes to your descendants, estate and gift tax free. That is pretty darn nice.
Now let's change the assumption, because the more money in the trust, the more income it can generate. But let's change the assumption that the charitable annuity will start low and increase by 20% a year over 20 years. But I still basically have a value of the charitable annuity being the same 800,000, so the taxable gift to my children is zero. So now remember, in the previous example where you had level annual payments, there was like a little over 700,000 went to the children. So let's look at the next slide. Okay. It starts out real low. And it basically, it doesn't get up to 40,000 until year 13. So you have more principal earning 5%. So all of a sudden,
Wow.
if I increase the payments by 20% a year with more principal earning income that will go to my children, at the end of 20 years, there's $1 million that goes to my children free of all gift and estate taxes. So can I actually increase the benefits of this? And the answer is yes. Next slide. It's called the shark fin clap. Now remember, the payments are not just the present value of all future payments. It doesn't have to be level. So let's suppose the charitable remainder trust on the next slide says, for the first 19 years, I'm going to give $1,000 a year to charity, and in year 20, I'm going to give the charity $846,000. So the present value of all those payments is still the same 800,000, but since I have more principal earning income, at the end of 20 years, instead of there being $1 million going to my charity, 1.2 million goes to charity. So the key is, the more money in the trust, that the income it earns in excess of the 75/20 rate goes to my children. So you like to have the payments in the charitable lead trust deferred. And in this situation, we call it a shark fin because it looks like a shark fin.
Right. Jerry, has the IRS said that they like shark fins or they don't like it? Can I sleep at night if I do a shark fin?
The IRS has issued several private letter rulings saying that in a charitable lead annuity trust, it's the present value of all future payments. So the IRS in unofficial guidance likes that. And if the IRS has to issue those rulings because that's what the law says. Okay, it's the present value of all future payments, and charitable lead trusts can vary the annual payments in the annuity. Now there's a gimmick where people use that they put life insurance inside the charitable lead trust. And we call that a gimmick because there's an Internal Revenue Code section that says that a charitable lead trust cannot pay the premiums on a life insurance policy. So, but the shark fin clap is an acceptable technique. The IRS has issued several private letter rulings that approve of it. And, you know, and if Congress, and if the IRS doesn't like it, they have to go to Congress to change the statute. And the bottom line is the charity is still getting all that money. So a lot of people say, oh, look, my charity is going to get $800,000 at the end of 20 years. Nothing wrong with that. So basically, I don't see that legislation being changed.
Right, right. Okay, Jerry, let's go over a couple questions, and then I want to talk about the Notre Dame Tax Institute also before we forget.
Okay.
Here's a question. I love the fee dispute idea, but how do you verify they donate it to the charity? Well, once they agree on the charity, I give them the name of my contact person at that charity and ask the contact person to confirm once they've received the check. Secondly, the charitable deduction is only 50% of AGI and the carry forward is only 5 years. That's correct, and we didn't mention that. If you give more than your...
No, it's 60% now.
60% for cash or 60% for anything?
60% for, oh, I'm sorry, it's 60% for cash. And in a charitable trust, you're not giving cash. You're giving them an interest in the trust, so it's 50%. But the key is, if you don't use it this year, you have another 4 years, another 5 years to carry it over and use it in the future.
And then somebody said, in 2021, I made a charitable deduction of 150. Can I deduct 300 or 150? The answer is 150. And then for the CRUT deduction of 409,000, is that restricted to a percentage of adjusted gross income, Jerry?
Yeah, it can't exceed 50. It can't exceed 50% of your adjusted gross income. Now here's the key is, if the remainder beneficiary in the charitable remainder trust is a public charity, you can use it to offset 50% of your income. If the remainder beneficiary in your charitable remainder trust is your private foundation, you can only use it to offset 30% of your adjusted gross income, or is it 20%? I forgot. It's less for a private foundation.
Private foundation appreciated assets 20%.
It's 20%, right?
Yeah. Okay.
But you still can carry the excess forward.
Right. Right. Okay. For the CLAD example, Jerry, is the growth based on stocks and bonds in the portfolio?
Exactly. Now, when you do one of these charitable remainder trusts or charitable lead trusts, you can't leave it alone. You have to have somebody managing the investment portfolio, because it's very important to make sure you have the right asset mix. In a charitable remainder trust, you got to pay out a certain amount, and therefore you want the cash to be available, so you can't have it all in growth stocks, or you're going to have to sell some of the stocks. So the most important thing is, when you use a charitable remainder trust or a charitable lead trust, someone has to watch the store financially, to watch the investments and make sure the investments are managed in a manner that will make the payments.
So let me just mention again, for the charitable remainder trust, the charitable lead annuity trust, the 800,000 is the exact amount the client puts in. And then the payment schedule here is the exact amount of payments the clients will get. I'm sorry, the exact amount of payments the charity will get. The 5% growth is hypothetical. If the growth is actually 6 or 7%, then the remainder will be much larger. If the growth is lower, then the remainder will be lower. Now, here's one last thing for everybody, especially you planners. I feel very fortunate to have been able to recommend to some wealthy people, 5 or 6 families, why would you leave everything to your children in the IRS when you could leave it to your children in charity? And the client says, what do you mean by that? And I said in the most recent conversation, well, your children are getting about 50 million free of estate tax. And then there's about 100 million that's going to your children and the IRS. Would you rather that 100 million go to your children in charity? And the client says, well, how does it work? And I say, well, when you die, we'll leave everything over an amount sufficient to get your children 50 million to a charitable lead annuity trust, which will pay charities selected by your children certain amounts over 20 years. And at the end of the 20th year, what's left will go to your children. And if your children manage it properly and the stock market does what it's historically done, it's going to end up over 50% or around 50% in the hands of your children in 20 years. They'll just have to live off the 50 million for the first 20 years. And when the client says yes, you can feel pretty good that a lot of money will be going to charities, and that keeps the children together as well, because they can run the charitable foundation together, and they do that pretty well despite the fact that their spouses may not get along. That such is life.